So are you with us, buddy?
Yeah. Hey, are you able to hear me?
Yeah, now I can, Adem. How are you?
I'm doing good. How are you doing, Dale?
Doing fine, buddy. You want to share your screen here?
Yeah, I'm having a trouble getting this thing. Oh, here we go. Okay. Uh,
So yeah, I'm
share.
correct. I remember, your style of looking for, what is really contrarian and going out and buying a lot of time for, what could be an outsized move that no one's expecting. And I think it was you were looking at the dollar then for
Yeah,
uh
I was looking at dollar and the yields. Actually, got really lucky with that because right when the 10-year hit like 10.7,
yeah,
I loaded up on bonds just because I, I thought that it's like you were saying the inflation data. First off, 2021 totally noisy, like base effects,
yeah,
everything. Like the market, you see these headlines. It's like, oh, highest inflation data in 30 years, and
right.
these scare headlines. But then when you go and actually look into it, it was basically all COVID sensitive areas, and that
So
could
you're in the
change.
camp that this is a transitory inflation event,
Oh,
like
absolutely.
Powell, like
Yeah.
Powell.
Well,
Okay,
unfortunately, yeah. Of just because I think I mean, even 1 or 2% inflation a year. When I say deflation, I'm talking like the sub 2%, and because over a decade that still adds up. You go to the grocery store and you still notice things are still getting expensive, but from a manufactured goods, like a real price of goods since the 1980s, since we entered the third industrial revolution, which was the infotech
right.
and digital age. um, there's been progressive structural deflation, and it
Right.
has been killing the Fed. Like the Fed. So to me, this, I see a lot of people talk about inflation, like, oh, the Fed,
It,
yeah,
the
they're creating asset
successful,
bubbles and
yeah.
all sorts of problems. But the thing is that, so when people say, oh, inflation started because we broke from the dollar, but to me, I mean, well, we had inflation before we broke from the dollar. That was the main reason we were breaking from the dollar. The CPI rose like 60% in the 10 years before they broke from Bretton
You're talking
Woods.
about Bretton Woods?
Yeah,
Okay.
yeah. I mean, the
Okay.
CPI was, it was averaging like over around 4 or 5% per year until they had a
Yeah.
break from it. And then some people say, oh, that wasn't a real gold standard, which is true. But then you go back to the pre-war. The only reason that prices started, remember, the 1860s to the 1896 was the Great Deflation, and the only thing
That
that
was the
got us out of
longest depression in
long
U.S.
as,
history
yep, it
after the
was
Civil
literally,
War.
yeah. I think there's a. I'm gonna
Oh, and
try to.
we have another Civil War going on now,
Yeah, that's true.
in a way. Okay. All
And
right.
when you look, I wonder if I could find that chart. I saw a beautiful chart
So does
of.
this mean that the break that we had in inflation hedges or hedges against, a weaker dollar like gold and silver really took it on the chin last week with the Fed just jawboning? They didn't do anything and they took $100 out of gold.
Yeah, see, the thing so I view gold as a deflation hedge, not an inflation hedge, because like I was saying, when the Fed is um so when the Fed is okay, so since the 1970s, when we entered the third industrial revolution, we were basically, all the effects from the second industrial revolution were wearing off, and the second industrial revolution touched every aspect of the world and the
Life.
U.S.
Yeah.
The networking from homes,
Right.
clothing, women, mass supermarkets, the Eisenhower building the 41,000 miles of interstate highway. I mean, the labor, the demand for all these things was so much. I mean, if you look at the daily life and the quality of living between the average American between today and the 1950s, it's not much different. Like, the car pretty much, there's been marginal gains in vehicles since the 1950s. There's been, same with air. We hit peak air service and quality in the 1970s. But if you look at the like from 1870 to 1940, these were huge changes. So the thesis that I'm going off of is that since the third industrial revolution started post 1970, it's only really been revolutionary in information, comms, and entertainment. Besides that, it's been very slow progress. And unfortunately, the marginal productivity from it hasn't kept up. If you look at total factor productivity since the 1970s, it's been in like a secular decline after, like a brief uptick in the 90s because of the .com, the gains from the .com, everything soaking in. But so the Fed at this point is stuck with their foot on the gas trying to fight this structural deflation. That's what's causing these asset bubbles, and has created a wave of unintended consequences like wealth inequality, asset bubbles, asset inflation, exact housing shortages. And the more they trying to get into each sector, try to fix it, they're making it worse. Like LBJ started his Great Society, which Nixon picked off as his Abundant Society, and JFK before him had his New Frontier. All these were like bigger government. We can do guns and butter. And they ended up finding out that butter was a hell of a lot more expensive than guns. And today we're stuck in this entitlement riddled economy. And so my thesis is there's a backdrop of deflation from the structural side, which the Fed is trying to fight. But by them fighting it, not even just the Fed, look at Japan, Euro, all of them are trying to fight this structural deflation. And they've printed waves of money, and it's just not, it's
your headline on your website. So what are the market implications of your thesis and your narrative?
So
you have a lot of people leaning the wrong way because of this, or are bull markets and equities which continue to this day with NASDAQ making new highs? Are they wrong-footed? Are they wrong-footed?
No. I think we're going to see higher asset bubbles just because that money, like higher order goods, like whoever gets that money, the cancel-on effect, the first people who have access to that money are the financial Wall Street. The problem today, literally the reverse repo since the 80s, there's been a savings glut. The problem isn't credit. Clearly, it's at this point, it's demand, it's attractive investments. And things were a little bit better after the 90s, like up to, 2000s, because China finally stepped in. And China was the big, China was going through entering their third industrial revolution, but they went through it extremely rapidly. And all those apartments and all those highways and malls and this huge transfer of like America, when we had the huge, in the 1870s, 75% of the US population was rural. Now it's 80% urban, 20% rural. You can only have that move once, and China.
Well, there is a movement back to rural out of the cities, but it probably is a small compared to what you're talking about.
Oh yeah, that big influx into the cities is same with China. They had to build all the infrastructure
They have a lot of ghost cities.
Yeah, the ghost cities, and the thing is, I was looking at the incremental output, dollar output for what's that measure? It's like, I just posted on my Twitter recently, but
of QE, the bang for the buck they get on.
China basically they're at like 3 to 4 historically. They just hit over 10. So for every $10 they're investing on infrastructure, they're getting $1 return. So clear and
weak.
China's infrastructure boom is over. And the whole theory was after 2008, all of the analysts were saying it. Oh, well, Peter Schiff even was saying it. Like all these guys were like, well, China, they're going to consume what they're producing. And it's going to be a huge move. But they're not. Yeah. They're running huge surpluses. So clearly, if you're running a surplus, it's deflationary because you're putting out more than you're consuming. And Germany, the Eurozone is the biggest surplus nation in the world. But the thing is, Germany and the Euro, they're also running QE while running surpluses. So that means Japan, same thing. So to put that in perspective to some people who don't might not know what that means, when the Eurozone's running surpluses, they're not issuing debt. So they're not putting out a lot of new bonds. So when the central banks like the ECB are buying their bond program, like their QEs,
Yeah.
they're soaking up whatever bonds are left. So that's why you've seen a huge transfer since 2015-16 of Eurozone investors buying US bonds, like huge amounts of bonds, because there's no Euro bonds. The
There's no
QE's
supply.
absorbing whatever else they can get. And I mean, no wonder the yields are negative. I mean, they can, there's no outside, same with Japan, like there's no coincidence. So you have the US now as the marginal deficit running nation. And, a lot of people said, oh, China's going to, take the place and consume all this stuff in the world. And China's clearly not done that. Their consumption to GDP, it's at like it's the lowest of any developed market. And let me just China.
Okay. Okay. Yeah. So you're talking about bond defaults in China, and uh,
Oh yeah,
they have been tapering, right?
yeah. They
I
have.
mean,
So
they've been
they have been.
tightening. They have been
So
tightening.
yeah,
Okay.
look at this thing. Final consumption as a share of GDP. China's is, it's back to where it was in 2005. It's barely 55%, and
So
America's
the
is like
handoff
75.
from an export economy to a consumer economy is fumbled. They fumbled the ball on the handoff.
Yeah, and the thing is, there's a guy, Alex Gershenkron, and he came up with the Gershenkron growth model, and the Soviet Union followed it. It's called economic backwardation. Soviet Union did it, Japan did it, some of the Scandinavian countries did it, China did it, and South Korea basically did. Basically, the idea was the government will come in, ramp up infrastructure spending, ramp up, make a really nice export industry. Then you'll use the money from exports, to build up your own domestic industry. But the problem is, eventually, like Soviet Union or Japan, you get to a point of diminishing returns, and you're supposed to do that handoff. But the people who come into power and the wealthy who made money off of exports, they don't want to just hand it over to consumers. So they keep, lobbying and getting, the wealthy get wealthier, and the export supply side in those countries end up, basically holding power until there's a huge crash. And that's what Michael Pettis, who wrote one of my favorite books, Trade Wars or Class Wars, last year. It's a great book, highly recommend it. He basically says that China's in that position right now. And he said they could go about two ways. They can rebalance their economy from the supply side to the demand side so they can stop repressing consumers and, artificially boosting infrastructure and exports. Because to have savings to fund the infrastructure, they're forcing consumption to stay low in China. That's how they've been able to afford all these infrastructure. Same with Germany. Same thing. There's big surpluses. They have to basically force their consumers not to demand as much. America's the opposite. So, but here's the kicker: China doesn't want to, the elites in China don't want to give up their power. And China's trying to do it now. They're trying to rebalance safely. But like Michael Pettis brought up, no nation in history has been able to rebalance willfully. It always comes down to like basically a huge crash happening, and then there's like a change of power. So who knows? Will China be the first country to rebalance, from the supply side to the demand side peacefully, like you just said, with the handoff? So far, it doesn't look like that because, and China's trying, the elites are trying, they're telling people like, hey, we're not going to bail out certain, bonds
Industry.
or industries.
Uh,
And, but the thing is, I mean, is that true? Who knows? I mean, usually China has like a hidden contract with their people. And it's been, hey, we'll make everything smooth with you as long as you tolerate our communism and our, government control. But if unemployment goes up, and that's the real thing right now, is so China's putting out huge amounts of surpluses, like excess goods, and it's basically forcing America to absorb all this marginal supply from Germany, the Eurozone running huge surpluses, Japan, South Korea, China. They're basically depending on America's deficits to fund these demand. And they'll happily buy the dollars because there's, the dollar's a safe haven. I mean, to them, you need the dollar. And China doesn't in my opinion, doesn't want a reserve currency, because if they have a reserve currency, they're gonna have to run huge deficits. They don't want it now, at least.
All right, since you're focused on China, isn't food security an issue there now? I mean, if you look at what's happened to, you could say there's no inflation, but there are exceptionally high prices for grains and meats. And, I looked at some live cattle and live hog prices, and I used to run on the floor of the CME, and the prices just completely blew me away to where live cattle's trading. And we all know beans went to, $15 and corn $7. Isn't that really the biggest problem? It always historically has been food security in China.
Yeah, that's true. And yeah, right now we're seeing. I mean,
They have
China
that
had their
clean plate.
entire pork supply
Yeah,
slaughtered in
right.
2019, and they've had a rebalance. And here's another kicker. Grain prices have
So would you
soared
be
in
short
wheat.
China, the F.A.C.E or something like that, Adem?
Yeah, basically that's what I'm, long dollar, long bonds. I think that the inflation was transitory. Another thing, in short China, another thing is, I like this thing. If you look at this chart, total fertility rate in the United States, basically the
Wow.
only period where we ever really had a huge stagflation, inflationary period was the only period where we had lag effects from a rising fertility rate.
That was after the
And we're back
war.
down. Yeah,
That was a
after World
baby
War, World War
boomer,
II,
right?
baby boomer. Yep, baby boomer, and then it petered out, and right now we're back. We're at like its all-time low almost.
Yeah, so how come there are people saying that it's the millennials are a bigger generation than yuppies? I sure don't see it on that chart. And
Yeah, no.
they're kind of saying that they're behind the housing boom, and that they're in the family formation stage. And so what do you think? I mean, there's a shortage. Do you believe there is a shortage of housing here?
Oh, absolutely, and that's all the government. I mean, literally the two sectors. No, I'm sorry, the three sectors: education, healthcare, and housing. The government stuck their grubby fingers in, and they've made the supply side worse with regulations, and the costs have soared astronomically, basically from, no doubt from the asset price inflation from the Fed. But you've created artificial demand from the Fed side, and then you've limited the supply from the governmental side. Like, I just see people say, oh, we need more government. And it's like, look at the three sectors with more government, we're spending insane amount of money on, and it's broken, and it's worse than ever. And it's just like, it's mind boggling to me, where I see some more people say we need more government, and more intervention. And I mean, that's not going to fix the problem.
Yeah.
Yeah, I don't know.
Okay.
I mean, yeah, I think, I
So
think
we'll all be living in tents if you don't have a home by now.
yeah, I mean, we're
So
even seeing yield-starved investors with all that, the
yeah,
savings glut happening. Your yield-starved investors they have two options at this point. It's like buy U.S. Treasuries because there's nothing else as attractive at that yield. I mean, they're not
or
going to go risk it
stocks.
other places. Yeah, or stocks. And even a lot of them are hesitant with stocks because the Europe was a prime example of this. Negative rates were supposed to push money into the markets. And the Euro investors were like, you know what? I'd rather lose 0.5% a year from negative interest
Yeah.
than going into the market and the volatility tax. It drops 50%. Then I have to recoup 100% just to get to break even.
You don't do you think that we're, with what's going on right now, that the markets after this parabolic run, and they have been parabolic if you look
Oh,
at the
yeah.
logarithms,
Oh,
are
it's
due
insane.
for that? Do you think we'll get that 30 to 50% tax you're talking about on drawdowns
I think
next year?
eventually, yeah. I mean, I don't know if it'll be next year. I mean, it'll be some black swan
How
event,
about this
but
summer?
I really, I don't, I have no idea. Like,
Okay,
honestly,
that's
I
fine.
have,
That's a
yeah,
great answer.
I am the
Uh,
worst market timer, so I
all
don't even
right,
ever
so
bother.
with all this massive liquidity in US households, what are they going to do? Spend it at Costco
Yeah, I mean, I don't,
on
I,
vacations, or
the thing,
some maybe they like having savings and they don't spend it
yeah, and that's what we're seeing today, which is technically against Fed theory. And I'm sure it's driving the Fed insane. And I think so compared to the taper tantrum in 2013, the yield curve has actually started flattening instead of steepening, even with the Fed talking about hiking. And I think it's because the bond markets at this point, they're like the fiscal impulse from the stimulus is wearing out at this point. And it was front loaded, the stimulus checks, it was front loaded. And by 2022, 2023, even if they do raise rates by then, they're probably going to be tightening into a recession at that point. I mean, the same exact thing as 2018. It's like once that stimulus wears off, you're going to start talking about tightening, pulling out, like they're overcompensating with QE at this point, clearly. I mean, the repo market shows it. I mean, it's probably going to go over $1 trillion, in my opinion, just because there's such a glut of savings and an imbalance as the Fed is emptying their treasury account. I'm sorry, the treasury is emptying their TGA account. So you're having an imbalance of bonds, a collateral shortage at the same time where banks are loaded with credit. So yeah, like you and I were saying, credit isn't the problem. It's attractive investments, and the Fed can't fix that. Like the government can, but I was reading these studies. This isn't like the economy of the 1940s, like going and repaving roads. I mean, you could do it to create jobs, but the roads are already built. Like that, Amazon driving to my house to bring whatever goods, them repaving the road or fixing up a bridge, it's not like that's going to bring huge returns to Amazon. I mean, they're still going to get here probably at the same time. Maybe they won't hit a pothole every now. It's not like they're blowing their tires out every time they drive down my road. So, I mean, the government could do it just, to create demand, but
like ghost cities, there'll be ghost
exactly.
roads.
But like we're seeing in China, it just doesn't work. I don't know. It's not realistic to think that they're going to just keep repaving roads over and over again. Not to mention the amount of workers today that would benefit from it is way smaller than the 1940s, 50s economy.
Yeah. So I mean, especially the demographic argument you showed with that chart. So say, for example, theoretically, and I'm not holding it to you, and I come to you and I go, Adem, I have $100,000 worth of risk capital. I realize I can lose it. That's why I call it risk capital. How would you deploy it?
Well, I would,
and cash is a position.
I would do cash. I would do. I mean, I loaded up on gold in 2017, and I haven't sold it, and I don't plan to because the more deflation there is, the more the Fed prints, which is going to drive it higher.
Okay.
Gold at today's, I don't know. I mean, it's relative, obviously, but I guess if you don't have any, I'd get some.
Okay.
And I like nickel. I think nickel has good supply side fundamentals.
Okay.
I think uranium's good. I think uranium got really hot.
Yeah.
That was like one of my best trades last year, but it's really, there was a ton of capital. Yeah. I think there needs to be more of a cool down in uranium.
So have the uranium shares pulled back at all? Or
are they still hardly.
Margin?
They're still pretty, I mean, CCJ is up significantly.
That's why we need like a 30% tax on the market so that these assets that you like could get cheap one more time.
Yeah, exactly.
So I mean, that's what I'm rooting for. 30% decline, and because you could own the best stock in a bad market, it doesn't matter. And therefore, all the things you just mentioned, nickel, uranium, all these things will get thrown out with the bathwater if we have one of those events this summer. So
and that's the thing that sucks about those, the volatility tax. Like Mark Spitznagel, the guy who runs Universa, the tail hedging fund. I mean, it's the volatility tax. That's what kills compounded annual growth rate returns. It's not like a stock underperforming 2% a year. It's you making 5% a year for 5 years, then a 2008 happened and it wipes out 50% of your capital. Then you have to literally mathematically make 100%, not even including opportunity cost at that point, just to get back to break even. So
Laura backs up your point. She lives in Argentina. And she said every sector, absolutely each one the government gets their hands on gets destroyed. Education, health companies, airlines.
I mean, there's more than enough empirical evidence at this point to show that the government can't manage it, because like what happened in the Soviet Union, they had great oil assets, but they had to use the oil assets. When you're an oil company, you have to reinvest in oil, for example. Soviet
Yeah,
Union's biggest export was oil and grains. They were taking all the
right.
profits from those areas to buy their military, and then when their oil wells broke down and their fields weren't, their people were dying of starvation, right,
Yeah,
under Stalin, but they were exporting record amount of grains to Germany. Like, to me,
right.
it's just crazy.
Hey, let me ask you, Adem, on your fertility chart there, the
Oh
rate,
yeah,
and when we had that bounce, where did that peak? 1970 or
it peaked in
1960?
1960.
Okay, it wasn't me.
Oh, were you after that?
Well, I was too young to add to the fertility
Mm.
rate. Anyway, so it was a joke too.
Oh,
So
I got it.
anyway, yeah, don't blame me for that pop, guys.
Uh-huh.
Anyway, Adem, best way for people to follow your great work.
Oh, I appreciate you having me on, Dale.
Yeah,
Oh,
what's the
best way?
best
Oh,
way?
yeah, my website Speculators Anonymous, or just Twitter at
So keep
Radical Adam.
okay, and keep an eye on China. They're at a crossroads here.
Yeah, I
Okay,
agree.
all right, great interview again, Adem. I
Great,
appreciate
thanks,
you
Dale.
being with us, my trading warrior brother. Good luck on the long dollar positions. I'm with you for a while, so
Great, thanks,
we'll
sir, and
see if that
hope to speak
happens.
again.
We will. You're a
Absolutely.
regular, buddy. You made
Oh,
it.
well, I appreciate it. Definitely. Thank you.
All right, buddy.
All right,
All
take it
right.
easy, guys.
All right. So everyone, we'll see you tomorrow. You could join the team for the morning edge, and you could shave and go in there for the morning edge and hang out with the team, see the bias chart, and ask Blake questions. And Steve and Stell and the whole team will be there for you. So have a great trading day tomorrow. We have Ben Maldonado with us. Should be another excellent interview. Thank you for your attention, everyone. You're very welcome. Adios.